As a business owner, you're constantly focused on the long-term financial stability of your company. Retirement plans are a great way to help reduce your taxable income while benefiting your and your employees' retirement. Besides 401k plans, another retirement plan worth considering is a cash balance plan. That's what we're going to discuss today, coming up next. My name is Chris Zeches, and I'm a certified financial planner and managing partner at Zeches Wealth Management. My father, who is also a certified public accountant, and I have built a wealth management practice that has one singular focus: to use our financial planning and tax expertise to help multi-generational families and business owners achieve more of what they love. In line with our focus, the purpose of these monthly videos is to address the issues that you are most concerned about and give you actionable advice that may be used to improve your and your family's financial outlook. Today, I'm continuing our video series about tax strategies you can implement using retirement plans and highlighting cash balance plans. Considered a qualified plan by the IRS, a cash balance plan is a hybrid plan that has some characteristics of a defined benefit plan and then elements of a defined contribution plan. It is an employer-funded plan where you set aside a percentage of each employee's pay, like a 401k plan. However, unlike a 401k, the ultimate benefit payout is guaranteed, much like a traditional pension plan. While cash balance plans may not be appropriate for every business, they are a great option for many different companies. Here are 7 reasons you might find cash balance plan an attractive option for your company. Cash balance plans offer high contribution limits. They are fully approved by the IRS and offer tax-deductible contributions, meaning that anything you as an owner contribute for yourself and your employees will reduce your employees' taxable income by that amount. Cash balance plans may be used alongside other retirement plans you have, and they offer some flexibility on who you cover. These plans offer predictable benefits for you and your employees. Another great feature is, unlike a pension plan, an employee can take their accrued benefits with them if they do leave the business. Now, let's take a close look at a few of these benefits. Higher contribution limits. One of the biggest advantages of a cash balance plan is they offer significantly higher contribution limits depending on the participant's salary and age. For example, in 2023, the maximum contribution limit for an individual in a cash balance plan could potentially be $398,000 versus the maximum for a 401k at $22,500 or $30,000 for those employees over 50. This allows you as the owner and your other highly compensated employees to save more for retirement each year. Now, how is a cash balance plan funded? Well, the amount of the contribution is predetermined by you, the business owner, based on various factors such as the employee's age, salary, and length of service in a formula that looks something like this. You determine the percentage per covered employee, and then you set the interest credit rate for the growth in contributions as a fixed or variable rate linked to an index such as a 1-year Treasury bill rate. Once a contribution amount is determined, the employer is required to make that contribution each year, regardless of the business's financial performance. There are some options available if the business has a slowdown, but a cash balance plan is best for businesses with strong expected revenues. The maximum lifetime funding of a cash balance plan is currently $3.4 million. When an employee retires, depending on the provisions of the plan, their payment can be made as a lump sum or have the option of receiving it as an annuity payment or rolled into another retirement account. For companies that want to augment their retirement benefits, especially for owners and to benefit those highly compensated employees, a cash balance plan can be an excellent addition to their retirement plan. You can have a 401k plan in place for all staff and add a cash balance plan as an incentive for the employees. Now, like I said, there is some flexibility in the coverage of the employees with this type of plan. You can set up a cash plan to be invested where employees are not vested until they reach certain characteristics, meaning a number of years that they've been employed usually. If the employee leaves before the vesting, they will forfeit any of those contributed funds. You can exclude employees, but you must follow non-discrimination IRS testing requirements. And you have to cover various employee groups at various amounts. These decisions, while seeming complicated, are made within the plan documents when it's first opened. Additionally, you do have predictable benefits. Cash balance plans are calculated differently than pension plans and show the account balance so employees can know exactly what they can expect to receive when they retire. With a cash balance plan, it is the employer that bears any market fluctuation, not the employee, which allows them to have confidence in their defined benefit. These plans offer predictable benefits to help you and your employees plan for retirement and are an alternative to small business owners who don't have access to a traditional pension plan. Another benefit of the cash balance plan is that it's portable. In today's mobile work environment, where employees don't always stay with one company their entire career, the cash balance plan is an attractive option because employees who desire to change jobs can receive payment of their accrued benefits, which can then be rolled into an IRA or 401k, whereas most traditional defined benefit plans are designed to pay out if the employee stays through retirement. So we've talked about the many benefits of a cash balance plan, but there are certainly some disadvantages. Cash balance plans have higher setup and administrative costs than other plans. These plans are complex and require services of an actuary to calculate the plan and provide an annual valuation. Still, these plans are less complex and easier to calculate than traditional pensions plans. If you are a small business owner and can't necessarily afford the fees, you may need to look at other options. You will also find that cash balance plans do offer greater contribution limits, but they do have strict rules regarding contributions and require a steady stream of contributions to fund the plan. Unlike other plans, this type of plan has strict distribution rules that may limit access to funds except for a specific situation such as an employee leaving. And one last thing to consider is to properly fund a plan will require financial commitment. Yes, you can temporarily freeze a cash balance plan or amend it, but it is designed to be funded consistently over several years. If you are not able to make the necessary contributions to the plan, that can result in penalties and other financial liabilities. In this case, a simpler, more affordable retirement plan such as a SEP IRA or a simple IRA may be a better option. In conclusion, cash balance plans offer many benefits to both employers and employees. If you are a business owner looking for ways to attract and retain employees while also securing your own financial future, a cash balance plan may be worth considering. If you want to set up a cash balance plan this year, the deadline to establish a new plan is up until your tax filing deadline, including extensions for the plan's first year. Please join us next time when we discuss profit sharing plans in detail and how they can be a good option for business owners that would like to increase the amount of their deductions they have and to save more money for retirement for themselves. Thank you for listening, and remember, we believe you can have a flexible life plan to achieve more of what you love. More financial confidence, more for your family, more freedom, more choices.